Yo, what's good, everybody? Let me know if y'all can hear me in the chat. One second here. Happy Tuesday evening, everybody. Moonar says, sup. What's good, Power Nap? Say, yo. Hermit, sup. What's good, guys? Oh, look at that. We got 9 people joining us so far. Not too bad for Tuesday, pretty late in the evening. It's almost 10 p.m. for me. I don't know where you guys are at, but middle of the day when we live on chain, right? Mongi says hello. How's the volume? Is the volume good? Just waiting to see. Can everyone give me a volume's good or a GM or something so I know that the volume's good? You can turn it up or down a little bit. Fine here. Good. Okay, perfect. So I thought what we'd do today is dive in a little bit more into some questions that people have been having about some of the techniques, about some of the system, about some of the things that I look for. There's also been a couple questions about using some of the data at ChainEDGE as well, some things about position sizing and risk sizing. So I think we're going to get into more of that stuff today. We've got a couple chart requests as well that we'll sort of blaze through those, but mostly what I'm going to use the charts for today is just demonstrating and highlighting the techniques that I'm using and what it is that I'm looking for. I know that Genghis had a couple questions that he actually put into a document a couple of days ago that I've pulled aside so that we can get through them, and hopefully I'll be able to answer all of these questions. I mean, I'm not in any particular rush. I don't really want to run it for too long. I think last stream was just over 2 hours, and I feel like that was a pretty good length. Obviously, the first one at 4 hours was intense and long, and can't really expect many people to go back and watch that whole thing. But as I've said a few times now throughout the stream so far, is that all of these techniques, I'm going to be going through them every stream. It's just the same systems, the same setups, the same things that I look for anytime I look at a chart. So they'll just become very repetitive. And that's really the way that these, that it gets drilled into your brain. It's just like repetitive, seeing them over and over again, marking them up on your charts over and over again to the point where as soon as you look at a chart, it's the first thing you see. I mean, I can remember back when I first started this journey of TA and learning how to look at a chart. Like, I would understand the concepts, but like putting it to practice and visualizing myself took time. Like, that took a lot of hours just sitting. And like, for me, really a difficult thing initially to grasp was market structure and like, how do I place those demand and supply zones? Because I could see one here, but how do I know really that this is with market structure and I'm not just like guessing and putting it anywhere? And that's really a big unlock, because, when you're first starting to look at a chart the way that the system that I use does, and you start trying to place your demand zones and stuff like that, you may think that that what you're looking at is demand, but then really if it's not with the proper swing points, you could just be, putting one in the middle of a range that could potentially act as short-term support or short-term resistance, depending on which way the chart's going. But in reality, it's waiting for it to get to the bottom, closer to the bottom of that range before it really finds the support. So that was a big unlock for me, was like really putting all the pieces together. So over time, we'll just sort of go through these more and more, and it'll become second nature to you. There was a time when I would look at it and like be so Well, really, the first thing that unlocked for me, the first major unlock for me was viewing a chart in horizontals rather than in diagonals. Shout out to Big Cheds, who really unlocked that for me, was just visualizing a chart in a sequence of horizontal levels. Because as soon as your eye adjusts to see those horizontal levels, instead of seeing the sort of choppy up and down action and sort of that sort of diagonal and cross and up and down sort of pattern, and as soon as you start visualizing all of the horizontals that are there, you can really see how the price interacts with certain levels a whole lot clearer. And that's a big part of the way that I look at charts. So what I think I'll do, I'm gonna pull up just briefly so you guys can see some of the requests that were put in. This is the list. Some of these were from last time, so we can go back and take a look. Like some of them are, I think, pretty much cooked of some of the ones that we looked at last time, but then some of the other ones were repeat requests, and we'll get through those as well, just to see how things played out from last time. Always good to find out how the follow through went and to take a look at your analysis and make adjustments based off of where you might have missed the mark. I think also I should probably do full screen. You don't need to see my little mug there. That way you guys can see the maximum amount. Okay, so what do you guys think? Do you want me to do the requests first or leave those till later and we'll just go in with the Q&A stuff and get that done so that we make sure we get through all of that? I think that's probably the best bet, but I'm not sure since we have people live here, maybe they want to get to the requests first so that way they can see what they want to see in the charts and then get on with their day. Also, did you guys notice that Etherscan added in the decimal points for GUE recently? Over the weekend, it got as low as 0.69 GUE was gas, which I've never seen in my entire 4 years in crypto. I had never seen Ethereum gas that cheap. Okay, Rock Monkey saying QA first. Okay. I'd never seen GUE that low. So Etherscan actually added in the decimal points so that people could get an accurate read on what gas was at, which is quite hilarious. QA. Okay, everyone's saying Q&A first. Okay, so we'll just dive into the Q&A. What I'll use some of these charts to outline some of those things. Okay, so I think what we'll start with is some of the questions that were from Genghis from the ChainEDGE Discord. He put together some questions, and there's some of the sort of basics from how I look at a chart. So what I'll do is I think I'll copy the question and pop them onto a part of a chart. So let's just open one of these up. And recently Deck Screener went through a thing. Every once in a while the settings mess up, and for some reason I can't get it to save without the grid lines in the background, and I can't stand grid lines. So every once in a while you'll probably see me turn them off. Okay, so what I'm going to do is I'm just going to move this over, and we can add a text box. Okay, so I guess everyone can see those questions there. And his questions were about market structure. Can I define it as I see it? Is the term structure synonymous with uptrend and downtrend the way that I use it? Swing zones, can you define them as I see them? Can I include how, if, wicks are involved? define what I mean by the daily range, explain what I do within this daily range, if that's the area that I work in, and if that helps me figure out where I'm putting my boxes. So supply and demand zones. Can I define a supply and demand zone? Sorry, a supply and demand zone. And ultimately, where do you look to buy? The majority of my system is buying the higher low. So I guess that was something that I said last stream, and it's definitely the majority of what I do is looking to buy a higher low in an uptrend, or I'm looking to sell the lower high if structure's broken and I'm trying to get out of a trade. Okay. So that makes sense to everyone, all those questions. Oh, Hermit. Hermit says, I'm Genghis, by the way. Okay. Well, there we go. Mr. Trismegist, butchering that. I'm not even going to go down. Not even going to do that. Is the picture quality okay for everyone? My internet was having a bit of a mood a little while ago. Just want to make sure the picture looks good. And this is just the first section of questions, actually, by the way. There's some more questions that people have put in, but we'll just get to these to start because it's fairly important stuff. Okay, so market structure. Can I define it as I see it? So what market structure is a sequence of, in an uptrend or in bullish structure, it's higher high, a higher high, like a high, a low, a higher high, a higher low, a higher high, a higher low. But then a shift in that market structure would be going from that higher low to a lower high, a lower low. And that's bearish structure. So you get a lower low, which is what a lower low is breaks the swing level, the swing low of the bullish structure. It breaks below the swing low, and you get a close, a candle body close below that level, which makes a lower low. And then the probability is once that happens, a bounce from there is going to give you a lower high, then a lower low, lower high, etc., until it gets to a period of consolidation. I mean, you hope it gets to a period of consolidation. I mean, we see so often how many charts just go to zero afterwards, but you get a brief period of consolidation. Now, it could be a matter of minutes, depending on how new the chart is. It could be hours, it could be days. I mean, if you're looking on monthly time frame, like say you're a swing trader and you're trying to trade something like BTC on a monthly basis, like you may be waiting a long time for that to turn around and for your trade to play out. So it's just each time frame has its durations, etc. So is the term structure synonymous with uptrend and downtrend? Well, yes, that's exactly what it is. So market structure it's either a bullish market structure or a bearish market structure. And in bullish market structure, the whole concept is that you want, if you're looking to get into the trade, once you've confirmed that you're in a bullish structure, you want to be buying the higher low in anticipation that it's going to create a higher high. Now, obviously, the earlier you get into that trend, the better, because especially when trading brand new coins, you have no idea when that structure is going to shift. So the earlier, the better. But then also there's, you can be too early, right? Like if it's a brand new coin and it does a quick pump and then dies immediately on you. So there's like a balance there between early, too early, or late. And also we're in this sort of weird phase of the market where, and what we've sort of been talking about in some group chats is just at the moment, you're either early or your exit liquidity, which is just sort of an unfortunate reality of the state of the market at the moment. Because so often we're seeing that you're going to get that initial run up, which will give you opportunities to get on board. Like you can find entries on bullish structure on low time frame very easily. Even on 1 minute, like you can find your entries off 1 minute, and any time frame for that matter. It's just the higher the time frame you go, the stronger the signal. I've had to sort of adapt that a little bit though, because for even the best of coins that come out the gate strong these days, you have maybe a couple days of them before the market kind of moves on. Unless you get those really rare occurrences lately of something that shows enough strength that it gets through some of the market cap hurdles and achieves a level of escape velocity. But even then, the market is sort of fickle right now. Like hot today, not hot later tonight. Like it's just the way the market is right now. So let's bring this Kobe chart over, because this has been a fairly decent coin recently. Had quite a good run up. Let's go to higher time frames and see what's the highest time frame that I can see structure. So it looks like H4 is probably the highest time frame, but I don't even really love the structure on it, because yes, we have a swing low here, but there was no swing high. Like you got this whole entire history on H4 or the 4R, there's no swing high. Now I would call this bullish structure because we can see it's been up only, and there is a swing low point here. So that's sort of what I would define as, like, there's your demand there. Now I also in the TG posted this chart as well, and I had boxed out this area here too. Now, why did I box this area out? I think I may have talked about this last time, but when you get a massive expansion in a candle with very little trade activity occurring within the body of that candle on either side, that's called a fair value gap. It's an ICT term, but it's also used a lot. What that means, fair value, is it means that in that area of price action, the market determined that it was a fair value, and so expansion occurred. And so what you often see is those areas get revisited, which this happened to do in this case. Now, if I were to mark out the structure on this and the range, so the market structure and ranges are sort of, they go hand in hand, because each segment of a high, higher low, higher high, those ranges that it creates are all part of the market structure. And sort of as I see this right now, this is your 4-hour range. And here's this fair value gap, which it's bounced off of for now. There's still chance that it comes all the way back down into here, because your range really is this full area here. But now it's a large range, right? Like it's almost a 1200% range. So it'd be a little bit, how far down would to come and tag that box from the Pico top is almost an 80% drop, which is a lot. It's a bit of a big drop, which is why during these large expansion candles that move that rapidly and that large of a percent move, that you kind of look for these interim segments to say, okay, where might price come back down to that people think is a good buying area? Because people that bought down here to see it go all the way up here, they don't want it to come back down here. So there's a chance that two things will happen. People that bought down here that want to support the chart will look to support it by buying in this region so that it doesn't come all the way back down to their entry. And two, people that missed this move, they're looking at it going, okay, where's a good time to get in? Well, as it starts to get down here and it starts to, the price starts to come down a bit, they're going to start to want to start clipping in because they know how much of a move that was. And whether or not it's because they're using this technique or it's just a psychological phenomena, but a retracement of that amount tends to get people to start bidding, which is what we've seen here so far. Now, if I switch down to lower time frames, so here's your hourly. We can also see, so market structure doesn't get broken on hourly until down here. And actually this candle came in and tagged this hourly demand here. Which would have also been an acceptable way to chart this out. You can see that in here, there was your hourly swing low. The range is from there to there. Here's your demand here. Oh, it actually just missed it. Although, depending on how you draw them out, and I often like to include the down selling portion of the candle before. So it tagged it there, but regardless, it's into this fair value gap now. It's bounced, seen a reaction, so there's a chance that it comes down again now. It starts to not look so hot as a chart if it does start playing around down here, but it still would be within demand. Okay, so hopefully, does that answer your question about market structure? And would you like me to go any further into what market structure is? I could look at bearish market structure as well. I just pull up a different chart because there isn't any on this at the moment. Picture quality is good. Awesome. Okay, well, while I wait for a response on that, I think that pretty much answers it though. Like, market structure is the sequence of highs, lows, higher lows in bullish, or in bearish, it's lower low, lower high, lower low, lower high. And the reason why you want to define, okay, so this is going to be important. The reason why you want to define market structure is because you want to understand whether you're trading with the trend or trying to take a trade against trend. Now, obviously, at some point, structure has to shift, and someone's buys or sells cause that to occur. So, you know, if you've got a large enough bankroll and you want to be the change you want to see in the world by forcing a chart in that direction, by all means. But for the majority of us, you know, punting a couple hundred or a few $1,000s into these early shit coins, that's not going to really happen unless you're buying on pump fund and the thing is at like 4K market cap and you scoop up like 10% of the supply. You know, like, we're not really going to move the chart that aggressively. So the best way to save yourself capital is to trade with the trend. And that's why market structure is so important. Let's move along a little bit. So swing zones, can you define them as I see them? Sure. So a swing zone or swing, let me remove these drawings. Oh, okay. There we go. So as I've pointed out many times, a swing is just a sequence of swing highs and swing lows. Now you can have swings within a range even, like you can see there were some swing points here, but we're actually giving some signal. Like, let me do my usual way. You can see that swing point, when candles failed to close above there, probability that it was going to come down lower increased quite a bit as you start seeing all these wicks. And then also, from here, you start getting a close below. Now, that's not a market structure shift in this instance. This is just a close below that swing point, but you're still in bullish structure. So a swing point is essentially a 3-candle pattern that is either, for in bullish, it's a low, a high, a low. And in bearish, or just for, sorry, not even for, this isn't even structure related, just for a swing high, it's a low, a high, a low, 3-candle pattern. And for a swing low, it's a high, a low, a high pattern. And they, these are very common patterns. Probably one of the most common things you'll see on a chart is a swing level, a swing higher, a swing low. And they're just used to give a little bit of an indication of the way that price wants to go. Now, if you look at this, it's pretty choppy, right? Like wicks, like there's swing lows, swing highs all over the place. But where they start to become important is when you get closes below an important level. But as you can see, and as I highlighted before, it came down and did what you wanted to see. Bullish structure, tag demand, and then bounced. Can I include how or if wicks are involved in a swing? So the wick is the defining point of the swing level. Like you can have a flat candle body top or bottom, and that be a swing point. It's very rare that you don't get any sort of wick involved at all. So in terms of swing points, wicks are 100% included. When it comes to a shift in structure, it's not about the wick though, it's about the close. Because when you're getting these wicks, it's showing, at least for a swing high set of wicks, it's showing an unwillingness to close above that level. And that sellers are stepping in that moment. So nothing about that range changed in any of these wicks here. It just showed that sellers were thinking, okay, this is probably a good time to sell. And what did we reach here? We hit like 5 million. So a psychological level. And vice versa as well for lows. It's as soon as you get at the extremities of a range, a close above, that you get your higher high, and a new range is formed for bullish. Or at the bottom of the swing level, if you get a close below, you get a break in market structure to bearish, and you get a new range defined. Now, I bet if I were to go down to 15, M15 here, actually, no, still fully intact. Okay, hold on. So on M15, so these are some early signals here, because M15, this was your swing point, and then you got to close above. So you had a pretty good chance, if you were just trying to quickly trade this thing on the 15-minute time frame, as soon as you got that close above there, okay, you're like, okay, here's my demand, because it was the low that created the high. Now there is a tiny little wick there. I wouldn't really necessarily count that as a swing low, because this is a very choppy segment, but you had your demand here, came down. You could have taken a trade there, because you do have, and you had a 2x there. Not bad. If you, sold that top, unlikely. You probably, you're probably holding because you're like, I wonder what's going to happen here. But as an early indication, that it was probably going to come down lower into demand was you got to close below that swing point here. It wasn't really much signal though, because as soon as it closed below, it went right down and then bounced. So, that would have been a tough one to sort of gauge. And because you're looking at the hourly on this particular moment, you're looking at the hourly range. You're not too worried about it closing below there on M15, and it got the bounce as you wanted. Sorry. Can you just clarify why you said there's no swing high on this chart? No, I didn't say there wasn't a swing high on this chart. I was saying there are times when you can get a chart where the candle has no wick. But on this particular chart, there is a swing high. I mean, on every chart, there's no such thing as a chart that's just up only with no swing points or down only with no swing points. It's always a sequence of lows, highs, higher lows, higher highs, etc. But yeah, there's a swing high on this chart. Sorry if that wasn't clear. Apologies about that. There's a swing. I was just saying you can get candles that the swing pattern doesn't have a wick, I think is what I was trying to say in that moment. Okay. So swing points, how if wicks are involved, 100% involved. Define what I mean by the daily range. Let's bring this up a bit. Okay. So I think that covers swing points. We've covered market structure. Define what I mean by the daily range. Okay, so a daily range is just a chart that's on daily time frame. See, there's no structure to this yet, so it's not a great example. Let me switch to another chart that has more history. Let's pull up smoking chickenfish, because that would have been a popular one. So, okay, well, I mean, this thing has continued to downtrend, although it looks like it may be trying to bottom. I believe in the last stream, I had said, this is your H4 range, top of the range, bottom of the range, and bearish. And we were trading somewhere around here. And I think I said, it's 50-50. And because we swept the top of the range, I would bet probability-wise that it trades to the bottom of the range. And look what happened. It's always nice to see when your analysis unfolds the way that you sort of probability-wise foresee it to. Like, this is not about prediction at all. None of what I do here is predicting. It's just probabilities. I actually tweeted a couple days ago that anyone that talks in certainties when it comes to trading, I try to just avoid, because it's probabilities based and nothing is certain in trading. You just want to be trading with the highest probability in your favor. Okay, so back to the question. What is a daily range? Let's just clear all this off. Remove drawings. Let's get rid of the volume. Don't love looking at volume. So a daily range, it's the same principle for market structure. I mean, all these questions really sort of circle back and revolve around market structure. What we can do is we'll just go through the sequence of events that took place on this on a daily time frame. So you had a swing high, a swing low. Now, technically, because this was a brand new chart, the original swing low would have been down here to play with this. Like, that's your daily range initially. But you had a swing low here that broke the high, making a higher high. So you broke structure higher here when it closed above there. And so actually this swing low became unimportant to that range. And your range then became this area. This was your daily range after it broke that high there. And so what you would have been looking for here on a daily time frame was to buy, or looking for a bounce for a higher low to occur in this demand zone here. So you can see, if we zoom right in, sweep, didn't get to close above, and then it finally got that candle to close above, which gave you your new range. And that was your daily range. And what you were looking for was a higher low here, probability-wise. Now, one thing you can account for is a market-wide sell-off, which occurred, I believe this was the night of our first stream, actually. So you can't account for that on the chart. Like I said, it's probabilities. So the probability was in your favor here, just the market had other ideas at that moment in time. And so as soon as you got that break below there, all of a sudden you're in bearish market structure, with this becoming your range. All of a sudden, this was your daily range in bearish structure, and you had a supply zone. I think I mentioned last time that demand, when you break below that and get a close below, often flips into supply. Now, technically speaking, this entire section here, we can get rid of this because this is no longer relevant. It's relevant in the sense of it being an important swing level, but in the sense of it being a break of structure, no longer relevant. But I'll re-highlight that because it, we can see that it was important because price came and rejected right off of it. Now, this whole area here technically is what you'd call supply. And you could actually still get another bounce up into here and get a rejection. We don't know yet. Because at this moment in time, at least based off of this swing level, to regain bullish structure, it's all the way up here. Now, that's a long distance, and I'd look to lower time frames because that's a bit of a ridiculous thing to say, is you want it to close above here before you get bullish again. I think you can get bullish a lot earlier than that on this particular chart. But that's your range, and I can't, let's see, let's zoom right in here and see if it lost the bottom of this range with this close yesterday. Oh, look at that. It just managed to hold the range. So yes, we're trading below right now, but this could just end up being another sweep. We don't know yet because the daily candle is so fresh, but it just managed to hold that range there. So that's a good sign that it's showing an unwillingness to close below the level. Well, we have yet to see, though, whether that becomes bullish or not, because I did see on the timeline, especially on, I think, 4 hour, I saw a lot of this. I saw a lot of people doing this. Trying to say, oh, we broke the trend line here, it's going to go up, and then no, it kept coming back down. Now, to me, this isn't a convincing meme diagonal. You already know that I don't love diagonals, but if they're super obvious and I think everyone else is looking at it, then I'll pay attention. But to me, that wasn't super, like, it's not really well defined. I wonder if H12 you got to close below here. No, H12 even managed to keep it, so that's a pretty good sign. Oh, no. Didn't want to do that. Does that, one second. So technically just a wick above previous highs in a break in structure. No, it's 100% for my system and the way that I view charts, 100% not a break in structure. A wick above is actually telling you the opposite. It's telling you price got up there, and as soon as it got there, sellers stepped in, and there wasn't enough buying pressure to get it to close above. So for me, that's, depending on the time frame that you're looking at, a wick above a level or a swing fail pattern or a sweep is good signal that you're probably going to trade lower. There was actually some discussion about this in the ChainEDGE Discord the other day, with one of the guys talking about it being more relevant to trading perps, because often what it's looking for is stop hunts from market makers and things like that, people looking to get people liquidated or stopped out. And that's very true in the perps world. But the way that I use them is very telling. And I can show you pretty much on every chart, especially the higher time frame you go, you start getting those sweeps counter trend. It's usually a good signal. I find them the best signal. So say you're in bullish structure. Okay, there's a few ways to look at it. If you're getting back to previous all-time highs and you start wicking that level and wicking and closing as a sweep at a previous all-time high level after a recovery, to me, that's pretty good signal. And another time that I find sweeps pretty good signal is counter trend. So say you're in bullish structure and you get down to the bottom of a range or even mid-range and you start getting wicks with a wick below and a sweep below a level and closing above, probably a good indication that it wants to go back to the top of the range, at least continue trading in a bullish fashion. And vice versa, if you're in bearish structure and you get to the top of the range and you start getting a wick and a close, like a sweep with a wick close, probably a good signal that it wants to go back to the bottom of the range. And that's the way that I view sweeps and SFPs. I use those two terms interchangeably. That a sweep is just a sweep of a level where price came up to a previous swing point, it swept the area, refused to be accepted either above or below, depending on which direction you're trading in, and closed back underneath that level or back above that level, depending on which way you're trading. Does that, Hermit, does that sort of answer your question about the daily range? I mean, it really all just comes back to market structure. That's really all it is. It's the range is just the overall trend. And I said it last stream as well. Like you can be in daily bullish, but then on lower time frames be bearish, and vice versa, be high time frame bearish, but get low time frame bullish. Like even though this is a bearish daily range, I'm sure there was at one point over here where it started to look bullish. Yeah, so you got the close below, but then here you actually had an hourly. You had an hourly shift in market structure to bullish, even within the daily bearish trend. But the thing is, what you're expecting or probability would say is that even though you're getting an hourly, and yes, you can take an hourly trade there, you're viewing it as a short-term trade because the larger, higher time frame, cleaner signal is telling you it's bearish, right? So there was a trade as soon as you got that hourly higher high, there was a trade to be had off this demand zone here, but you just have to take it with a very short-term view. You know, you had 1, 2, 3, 4. Okay, well, it went from 2 p.m. that day to 11 p.m. the next day, or 11 a.m. the next day. Now you have no idea where it's going to top out. Although, look here. So we talked about sweeps just a second ago, right? Swept a level. Swept a level after getting some nice closes above, even though, yes, there was a sweep here. So you weren't really sure what was going to happen yet, but you had this hourly break in market structure, higher high, into demand, below region or the consolidation that created the high, into demand, and there was a trade there. And when you got up here, what happened? You got a sweep right there, And because you were already in bearish high time frame structure, you're seeing that potentially a good reason to want to get out of the trade. And then also what we had here was that swing level that was marked out off of daily. So there's a couple signals here that align the higher time frame bearish against the lower time frame bullish. Was that you got a sweep, price came down and closed back below that important swing level from before on daily, underside tagged it, and then sold off. I mean, these are just, you're putting layers. Like you're having your high time frame analysis and you're building on top of that lower time frame reasons to switch your buy. But being cognizant of the higher time frame structure. Because there's no reason why you can't trade bullish in a bearish structure or look for reasons to sell or short, depending on what instrument you're using, in bullish structure. It's just about taking the fractals. It's a very good word for trading. Fractals is time frames are just fractals of a higher time frame. That's an important one to remember. Let me look through the chat for a second. There was a question about one of the charts, which we'll get to, asking about Cicada from Cobalt from the Discord. So okay, so it does answer his question. He's getting confused about terminology. Where sweep is another example. I've been finding conflicting definitions, but this is all clear now. Searching up these terms from like a Google or something like that probably isn't going to find the best results. These are just terms that is trader speak that I've picked up over the years from people using these same terms over and over and over again. Sure, there are hard definitions to some of these things that may have a different practical use case versus how we use them on CT. But they're pretty widely, they're pretty common knowledge and widely used. So yeah, a sweep or an SFP, essentially what it is, well, I described it's a sweep above or below a swing level that closes back within the range of the trading range. Hopefully that helps. Okay. And also, so I'll just wrap up this portion with a further analysis on smoking chicken fish. So what I had said actually last time was trade at top of the range, probably comes back down and trades the bottom of the range. Now you have had some acceptance below on H4. Now this is one of those instances where charts don't align on timeframes, which is annoying about places like Deck Screener or even Photon or Bullx or any place really that has on-chain charts is different timeframes. Your lines won't line up. Just look at how misaligned that is. But on hourly, it was right on the swing point, and down here, daily was right on the swing point. Now, what I'd say is because this is a daily range, use the daily swing point as the ultimate proof. And what we can see is, as I said last time, traded top of the range, probably going to come back down bottom of the range. Now, if you get a sweep and close back above, that's probably a bullish indicator. And look at that. We're starting to get signal here. So on this particular chart, if someone wanted to take a trade, this is actually really good risk reward right now because your risk is defined. You start getting more closes below the level. That's your invalidation. Now it's a daily time frame, so we're only a few hours into today, but you're starting to get a reaction. So, risk defined, clearly defined. You start getting closes below here again. Different story. If I switch down to H4, let me just, I hate doing this, but because this is what it's showing me, you can see on H4, you even got sweeps here. You got that sweep there. Starting to show reaction. So this is probably worth a punt because at the very, very minimum, because we're still trading within this H4 range, you just play it as a range play. Trade it to the top of the range, trade it at the bottom of the range. Well, risk defined, you're thinking, okay, let's get back to the top of the range. I'm not saying it's going to get there. Like you have the middle of the range to contend with. There's three key areas in a range. There's top of the range, bottom of the range, middle of the range. So who knows what happens when it gets up here? It could just tag into this supply again and reject off, but very clearly defined trade right now. Say you're going for back to top of the range. I mean, it's more than a 2x right there. So I'd say this is worth a punt just to complete the analysis on this chart. But again, importance of sweeps, especially when you're counter trend. Bearish structure, you get a sweep top of the range. You expect, probability-wise, that you're going to get bottom of the range, and that's what's occurred. Now you're at the bottom of the range, got a sweep. Well, why should it not go back to the top of the range? What I would look for if I'm going to take this trade is building in a stair-stepping sequence. And so even on the way down here, you could see it created mini ranges within. If it had started creating the mini range and then all of a sudden, oh, you're getting a close back above one of these, you're thinking, okay, well, maybe that was the extent of the pullback. So for here, if I were to take this trade right now, stop down here, or just manually watch, see if you start getting closes below, what you want to see is, okay, let's get an H4 close above there, because that was this mini range within the range, the swing high that created the low. So if you get a close above there, you're just looking for it to create stair steps. And if you get here or somewhere up here, and all of a sudden that stair step is broken to a, not technically a lower low, but within this pattern, a mini lower low, like a intermediary break-in structure, I guess I would say, well, then maybe that's the extent of the trade you're going to get. Who knows? We can't really tell that far in advance. All we know is right now, your trade is risk defined. Okay. And Munar says he actually took a punt 16 hours ago around 40 mil. Let's see. Awesome. So you got in, pretty much bottom of the range. The range is defined. And you know where to cut if it goes against you. If not, hopefully this just fucking goes back to all-time highs. That is yet to be determined. But the beauty is your risk is the least it's going to be from entering around this area. Sorry, excuse me. Okay, so let's see what some of the other questions on here were. So define daily range, did that. Is that the area I work in? Yes. If the chart's giving you daily range, you're using that range to define your overall structure, and then you're looking for trades within that. Because the daily range is, first of all, not many coins make it to having structure on daily these days. But you're just, increasing time frames as the chart allows. So, a brand new chart, you're going to start on the 1 minute structure, it's very low signal. And oftentimes, you'll just get price slicing right through that. Doesn't mean that it's bearish. It's low signal. So it's still figuring itself out. And then, okay, so we had a question about the range. Does that help me figure out where I put my boxes? So supply and demand. Yes, very much so. Let me see if I can find a chart with even more history so that I can highlight some areas. Let's open this Billy chart. And someone had asked for analysis on this. I mean, it's in bearish structure at the moment. I've seen some people talk about this being an area of a lot of liquidity looking to enter. So could be the case because it's stabbed down into this demand down here and it's given a reaction. For me, it's a lower high in the making until proven otherwise. And the proven otherwise would be a close above here. But we'll see what happens. It's still early. A lot can happen. And, overall, it's better to be bullish in crypto than to be bearish. But I just do what the chart tells me. So, does the daily range determine where I'm putting my boxes? Supply and demand, 100%. So let's get this. Let's start from here. There was the top of your range. Actually had some wicks and sold down a little bit, but it found a bottom, which went on to create a higher high. Right there, as soon as it closed above. As soon as that happened, you had demand down in here. Now, it didn't actually come down and tag that demand, although that's the demand we're visiting now. But what did I say on the first chart that we were looking at? When you have expansion of that amount, like it's not too huge, but you do actually have a fair value gap right there. And what did price do? It came down, tagged that area, and sent. So if you get a sequence of a couple days, like, yes, this is a lot to remember. And I don't expect you all to grasp it all just from looking at it 1 or 2 times. And that's why we'll continue to go through these concepts every time we look at a chart. But we had a fair value gap here, an area where price expanded and didn't trade within, leaving this gap that was considered fair value. And so that's why that box is there. And it actually came. So you could have drawn this after this daily close saying, okay, I've got this gap here. Doesn't mean that you don't know what's going to happen yet, but you suspect that that's where it might come to, and that is where it ended up coming to. So in that particular instance, that's where that went. And so here was the top of your range. You got another higher high, and you come down. Okay. There's your demand. And in this particular case, it did actually tag it. I guess I need to go a little bit slower on the defining of a demand or supply. Because what I do is actually an adapted version. And there's a few different terms for them. They can be called order blocks. They can be called supply and demand. They can be called support resistance. What I use is an adapted version that I find best suited to on-chain. Because very often what you'll see for order block style is just the down candle before the down. Sorry, there's a way to say this. It's the down candle before the up candle that creates a higher high is often the definition for an order block. Now, when I was first learning how to use this system and how to draw these out, that is what I was doing. But time. And so I started off in the perps world. Like that's where I was learning all this stuff and applying it to there. Um, and I was getting my ass handed to me. I'll be perfectly honest with you. Like trading with the big boys, trying to play perps, you need to really know what you're doing. Otherwise, you're going to get your ass handed to you. Like really clearly defined where your trade thesis is invalidated, knowing where to place stops, understanding the dynamics of complicated complicated and sophisticated market maker strategies. Like this was all stuff that when you're learning how to trade is a brutal environment. So I got my ass handed to me. I'd already been living my crypto life on chain, so I was trading perps actually on DEX perps. Like what was that big one? What was the name of that big one? It's been so long now I can't even remember. That's horrible. Oh my goodness, what was the name of that main big one? Sorry. Oh, GMX. So I was, trading on places like GMX, G-Trade, other places like that, like decentralized perps. But, you're playing the price movements of sex players. So like you're susceptible to all that. And I was getting my ass handed to me. I was like, this is ridiculous. I can understand what's going on, but I just can't fucking figure this out. So I started focusing more on-chain for shitcoins. And that's when the system sort of really clicked for me. And it started working out a whole lot better. And my profitability started going way up. But in using the system, I had noticed that demand zones were actually a little bit different than they were for perps and the way that I was learning how to use them. And so mine are actually a bit of a modified version where I include the down part of the wick of a candle before, if there is a down part of a wick, because what that is actually selling occurring before the buyers step in to send price higher. And that's really what demand is you're looking, it's an area where the buyers demand outpace sellers supply. So that's what creates a thing called a demand zone. And that wick is part of that selling, as well as the wick all the way to the bottom is the bottom of the range. So my modified version of order blocks or supply and demand emerged over time. Like this wasn't just, it happened overnight. It was after sitting with these charts for months and months and months and months, and finally realizing, because I would be waiting, I would draw my boxes the way that I had been learning for perps. And then oftentimes price would just never get there and it would move. And I was like, why is that happening? Well, I was like, well, if I do this little modification and I just incorporate that extra little bit of selling there into where I'm marking out, it actually becomes a much better area to look for where to buy. And I also include the bottom of the wick because we all know that on-chain can, one big sell or one big buy can send price quite dramatically just because of the liquidity constraints. But even then, I hear so often from people like, oh, you can't do TA on these shit coins. You can't do TA on these low market cap coins because all it takes is one big buy or one big sell and it throws your TA out the window. And which is true to an extent. But what I do find is more often than not, even with a massive sell, it's ending up right in the areas that I'm looking for, the probability wise. It's just about knowing market structure, right? Like it's almost like, it's why I call it voodoo and squiggles for the culture and astrology for men, because from an outside looking in, you would think that it's bullshit and how could you predict? And again, nothing of what I'm doing is prediction, it's just probability. And if an area fails, the area fails and then you lose structure, and that's just the name of the game. It's not bulletproof, and it's not going to work out 100% of the time, but what it is putting probability on your side. So the reason why my boxes are a little bit different than you may see other places is because they're modified specifically for on-chain. And I find that they work really well. Yeah, so that's the reasoning and the positioning of a demand. Now, if you look, the next time that demand was broken, or that the range was broken, because this was your range here. Well, hold on. So this one's a bit complicated because there's no actual swing high here. You don't have the 3 candle point, right? Like those, that's flat. So you actually only have 2 candle points before the next one up. So this one was a bit difficult, but as soon as this one's a bit tough to read. I'll be honest. Like this one, looking at it, it gets a little bit confusing because this is truthfully your range. But then as soon as you had this swing point here, it's almost probably close to the middle of that range, but you had that swing point there. What did you get here? It wasn't until here that you get a higher high. And so then your new demand became this region here, which is a fairly large region. But you can see you had some responses off of it. But something you had to keep in mind was how high of a market cap this thing was getting to. And when it broke above that high, you didn't get that much distance out of it. But you're still expecting, probability-wise, for a higher low to form somewhere in here, which it tried. There was an attempt, but it was a weak bounce. Ended up coming all the way to the bottom. Weak bounce, close below. I hope that this is helpful for these supply and demand zones. It's really going to come down to me just repeatedly showing them to you. And I know this can get a little bit dry and a little bit long-winded, but it's really the way that you learn how to draw these things out. And then look, as soon as you got that close below, structure was broken. This flipped into supply. It didn't actually, it was so weak and the sell pressure was so high that you never even got a tag of supply, which was actually quite interesting. How aggressive this selling was, that you didn't even get much of an opportunity to get out. Like you sold below it, didn't even like it. There's a gap in between that, right? You didn't even tag supply before it sold off more. And so then let's just keep this lesson along. So you had a new daily range. This was your daily range because it was the high that created the lower low. So this was your new daily range. And you can see 2 days ago, it closed below. Now it's attempting to reclaim that level and having a reaction. So we'll see what occurs here. But really, as it stands right now, excuse me, as it stands right now, you had a close below. This is now your daily range from here to here. Lower low, close below. What I suspect, probability-wise, and perfectly fine to be proven wrong with the close above, but for now, what I suspect is that you're looking for a higher low or a lower high somewhere in here. Now it can come all the way up to the top of the range before rejecting, or you get a close above here, then all of a sudden your daily structure is shifted back to bullish. And then you'd look to rebuy, you'd look to buy on a retest. So we'll monitor, see what happens there. Hopefully that helps a little bit with the boxes. I know they can be a little bit complicated, and believe me, it was one of the things that took me a while to truly grasp and understand, because you look at a chart and you see all these clusters and down candles before and up, but like you're like, really, where's the bot, where's the demand? Which is why defining the range and understanding how to define the range is so important. Because until you figure out the range that you're trading within, looking at a chart can seem completely bullshit. Like from a if you don't understand the range and thinking about TA and hearing people talk about TA, if you don't understand what the range is that you're trading in, it can seem like bullshit, because you're like, well, why not this area? And why not? Well, because there's a reason behind it. This is a fairly strong reaction here, though. So hopefully, if it can get the close above here. Now, again, it doesn't mean there wasn't a trade to be had here, especially if you go down to lower time frame. Yeah, like on H4, look, you had a close below that swing point there, which meant that this was the swing high, and you've actually just gotten a close above on H4. So on H4, there is a trade. There is a trade here, because that became H4 demand. Counter trend to the uptrend. Now, I don't know. It hasn't tagged this demand yet, so it may just go up. Who knows? I can't tell yet. But there's a chance that it comes down and tags in here to find a higher low on H4, counter trend to the daily. We'll see. So hopefully that answers at least a little bit about the boxes. We're gonna have, I'll just keep going over those every time we do these streams. Can you define supply and demand zones? I mean, I pretty much did that, right? So, or not pretty much, I did do that. Demand zone is an area where demand outpaced supply, where people were selling, but buyers stepped in, and that demand sent price higher. And if it sent price to a higher high, giving you a new range, that's where you would look to buy a higher low, is into that demand, because you expect buyers to step in there again. And conversely, for a supply zone, it's an area where supply or sellers outpaced demand, meaning that the amount of buyers were exhausted and the selling was just too much pressure, and it sent price down. And if it creates a lower low, you look for that area to be a lower high to form. And you would either, if you had been a holder and you didn't manage to sell before the sell off, well, then it gives you an opportunity to sell into that supply on a lower high. Now, keep in mind, this is all from a perspective of being a trader and not a hold a token for the whole cycle moon boy perspective. Nothing wrong with that, and many people make a lot of life-changing money trading that way or investing that way, I guess is how they would put it. But that's not what we're doing here. And so I think pretty much I've answered all these questions. We can go over them again in the future, but this particular set of questions, I think we've answered. Okay, so let's move along. Just give me a second. Okay, so I had a question about portfolio sizing and risk management. So let me bring that into here. Let's put a new text box. Ooh, okay. Let's see if we'll be able to see all that. Mhm. Okay, not the best formatting, so I'll have to do better next time. What criteria do I use to determine position sizing? A few things. Is it a super early gamble? Like, is the token only a few minutes old and I'm just trying to catch the initial momentum? Well, then you're going to put a much smaller gamble into that trade. And essentially, the amount or size of that trade that you put on is your stop loss. It's just an amount that you're saying to yourself, if this goes on to 10x or 100x, well, I've got in early enough that that small bet can turn into an okay or decent or good sized bag, depending on how far it runs. But also, if this trade goes against me and I'm not going to have time to sell because it just, they, the devs rug and just the price nukes to zero, uh, or any other number of reasons, contract risk, honeypots, etc. Although this today, getting caught in a honeypot should be less and less common because we have enough tools at our disposal, especially if you have something like ChainEDGE, like something I really like doing. And I actually very rarely check any security scans outside of two things. I'll check to see on ChainEdge, were the wallets able to sell and profit within the last minute or couple minutes? If yes, okay, at least in this moment in time, I know it's a sellable coin. Then when I load the contract into whatever terminal I'm using, if I'm using Photon, if I'm using Bolex, if I'm beta testing our ChainEdGE terminal, which is in the works and will be launching sooner than later, just still in beta at the moment. Then I'll check what the security scan within those systems is saying. Because I used to be a huge user of a lot of scanning tools, and one in particular, which is it's a great tool, was Quick Intelligence, Quickie, great scanner. But I found that it was just too much information, and I would be doing these scans, and it just tells you so many different things that you're looking for a reason. And like I found it was just you're looking for a reason to not buy the token, as opposed to wanting to buy the token and just making sure it was sellable in that moment. Because there's any number of reasons why a contract will look sketch. And, a lot of the times those things are true and can eventually lead to some like a honeypot or like a delayed honeypot or a rug or whatever. But you can't really dwell and sit there overthinking it too much because you're gonna miss 9 out of 10 opportunities if you do. So I stopped doing thorough security checks and just using like really basic. If I can see that wallets are selling on ChainEdge, like 90% of my concern goes away. Doesn't mean that I don't look at it as a short-term trade and like understand the risk involved, but um, so what I was saying there was that chance of you should find that your chance of hitting a honeypot is lower and lower with the tools that we have available to us. Um, but it doesn't mean having to become an on-chain sleuth or digging too deep into it and bear talking yourself out of buying a position and putting a trade on. So for the super early trades, your position size is your stop loss. So whether that's a couple $100 or $1,000 or whatever your risk tolerance is, But for these gambles, it should never really be more than 1, maybe 3% of your portfolio size. Especially if you're taking gambles all day, like, you're going to hit a lot of misses. Now, we have really good tools at our disposal for discovery and tracking and group chats. So it lessens the probability of hitting something that's going to just rug on you or something like that, or go to zero. But it happens all the time in the trenches. So just be willing that as soon as you put that bet on, that it could go to zero. And that's how you deal with the position size of that. So say your portfolio size is $1,000. Now that's pretty small, and difficult to sort of only put on like 1 to 3%. So I would say in that instance, you have to go super degen, be specifically somewhere like Solana, and you're probably going to be putting in for the first couple trades, maybe 10 to 20% of your bankroll. So your discovery has to be pretty quality, because you can lose that money real quick. And in that essence, it really is just gambling. But say, when you're in like the $10,000 to $50,000 portfolio size, putting on a couple $100 trade isn't gonna blow up your account, and you have a lot of ammo at your disposal to be able to make an impact, and you can grow that 10 to 50K pretty quickly. Now, you can take sort of two strategies with that. You can take larger positions on something that you perceive to be less risk. And there's ways to give yourself more confidence in that. One way being utilizing our holdings data, and looking for tokens that smart wallets have a level of confidence to hold a certain amount of dollars in that token in expectation that it's going to go higher. So say your bankroll is 50K. Well, if you're going to stick, at least from the gamble's perspective, to that 1 to 3%, well, you can be putting, like $500 to $1,500 in a trade in a gamble, and you're not going to blow yourself out. And for a higher conviction trade, you could be putting 10K, 5K, 10K, whatever it may be, into a trade that your expectation is not necessarily a 10x. It could be, depending on the token and the environment that we're in. But you know that if you're supporting your thesis with data, or however you go about building a thesis, whether that's from a community-based approach or a fundamentals approach, if you're mostly trading utility coins, that you can be putting in 5, 10, 15K and looking for that to give you a 2x. I mean, even if you're putting on it using like 5K and you're trading quickly, but it's only a chunk of your bankroll and you're wanting to go the gamble route, I mean, you could be putting 5 or 10K into a token and only looking for a 30%, 40% move, and you're still walking away with good money. And you just have to make sure that you're defining your risk really well, so that if it starts closing against you, you just get out of the trade so you can preserve as much of that capital as possible. And then the larger bankroll you have, you just have to be adjusting risk proportionately. So for the majority of your capital, you might be putting that into safer plays, but that you perceive, or your thesis is, will outperform Solana, or will outperform ETH, or will outperform Bitcoin. And you just split up your bankroll into segments. So say you take say you have 100K and you're like, okay, I'm going to put 80% of this into smarter growth positions so that I might get a 2 to 3x out of it over slow and steady growth. And you can rotate that around depending on what plays are available. But then you keep 20% of that stack to just be using for gambles. But with those gambles, you're position sizing in a mindset that the position is your stop loss. Depending on the age of the coin as well. But realistically, anything under $1,000 or $500 bet with that level of bankroll, you just assume that that's your stop loss, because there's many times where you could put that in and sell and completely forget about that token. And then a month or two later, the thing is mooned. So if that's the way you're going about it, if you're just strictly separating a gambling account versus an investment side of your account. Excuse me. I hope that's answering how I would go about position sizing based off of different size of account. You also have to keep in mind, like, okay, I managed to turn, like, just say for whoever, say you were like, okay, I took $5,000 and I turned that into $100,000 using this specific type of strategy. And that strategy works really well for you. Are you going to have the same sort of outcome if you change your strategy and go a safer route? No, but it's a good way to protect the larger portion of your capital, but then just keep doing the same thing with a smaller portion. Just say, okay, my more gamble oriented bankroll, this is the ceiling of how much capital I want to be in there. So you run that up, you pull more out, and you put that into safer bets or safer investments. And then you start the process over again and you bring it back down to your baseline threshold and you run that up. And if you lose that, you're only losing a small portion of your overall capital, and in an amount that's not going to devastate you. It'll be a setback temporarily and a pain in the butt, but no. If it's your clearly defined smaller cap, faster flip gambles account, okay, so I blew out that $5,000 or that $10,000 or that $20,000, whatever the percentages of your bankroll, you still know that you have the majority of your capital preserved in higher quality tokens, and you can just restart a gambling wallet and do that process again. I mean, if you have a system that is working really well for you, I don't like to fuck with a good thing. Like if I have a routine that's working for me, if I have a system that's working for me, like I'm very systems oriented and I'm very detail oriented, that I don't want to fuck with a good thing. So, which is why I enjoy the trenches and why I still play in that arena. So just separate what you're doing with the capital and don't allow yourself to cross the threshold of how you're splitting that up. And it's independent for each person, but what you don't want to be doing is taking your $100,000 bankroll or $500,000 bankroll and throwing that all into memes, into low caps, because that's a real good way to quickly lose your capital. But if you just separate and legitimately, like full on, just have separate wallets for these things, keep them completely isolated, and you can fund whatever. You can take your winnings, take those off the table, dump them into your larger account, put it into safer quality assets. And if you blow your other account, then you can siphon some back and refund it, but refund it from like your baseline low threshold so that you know, okay, this is my run it back up stack. Then you're not going to blow yourself out. And you're going to, if you have skills and you have a system that works, you're going to be able to run it back up. Okay, next part of this. What is my portfolio management like in regards to memes, majors, stables, and for memes, you spread risk between different classes or have a bread and butter you go for? I mean, for me, and I've mentioned this before, that I denominate in ETH or SOL. At the moment, I don't have any stables on hand. I put the remainder of my stables that I had to work, not at this recent flush, but the one that we had maybe a month or so ago. So it was a little bit premature, but I also have a long time horizon for majors and where the cycle is going to go. But majority of my capital is in ETH and SOL. And then, as I've mentioned before, I don't really like holding positions too long. Like I'm a levels trader. I'm a day trader. So for the most part, when I take a trade, even off of a high time frame, like someone had asked in the Telegram group a couple days ago, how it is that if I'm taking a setup off daily, that I'm closing a position out. Now, a key thing there is structure. Like if I put a trade on and I've managed to catch the bottom of a range or as close to the bottom of the range as possible on a daily time frame, and it's built up layers of lower time frame demand on the way, like a sequence of, as we talked about, like say you're on daily and then you're building up hourly or 4-hour higher highs, higher lows, demands, and honoring those levels, then I'm more comfortable to hold that trade for a day, 2 days, 3 days. I don't usually hold anything much longer than that. And if I'm feeling like it's fairly risky, even off a daily level, like I'll just look to see what the H4 range is looking like within that daily range. And when it gets to the top of the range, or if it gets to the top of the range, more often than not they do, especially if you're waiting for your setups, especially on high time frame where the reaction is higher signal, like a daily, I'll just take a look at what happens at the top of the 4-hour range, and I may just cut there because I like to sleep. And I don't like going to sleep with risk that I don't like going to sleep holding overly risky. I view the market in two segments. There's the level of risk that I perceive on ETH, and there's the level of risk that I perceive on Solana. Doesn't mean that you can't hold Solana coins, because it's very possible, and lots of people do, and they make lots of money. But for me, I prefer to exit those trades within a shorter time frame than I would on an ETH play. Now, market conditions play into that, and at the moment, I don't really view anything as overly long term. So take that for what it is, but you can enter your trade off of a daily trigger, but only look for it to unfold on a lower time frame, like 4-hour. Like I was showing earlier with the 4-hour range on SCF, even in a daily range, it had a 4-hour set of triggers. So those are the types of things that I look for. So in terms of what my portfolio management looks like, I mean, I'm for the most part trading in and out of memes to grow my denominator bags of ETH or Solana. And if the opportunity arises and we start to see utility be back in favor, then I will also trade those. Like I view the whole market as a meme, and they're all just memes with different tickers, and some have promises, and others are just for fun. So I don't really care what the ticker is, as long as the environment is bullish for it. But yeah, my for me personally, my main goal is to grow my denominator bags. Okay, 1 second. Okay, so PowerNaps is saying his gamble pump fund port is pretty terrible and super time consuming, so definitely looking for higher quality memes. And then he also said, I thought some of the higher market cap attention ones like Billy were safer, but they've also been pretty down only. They have. And the market has not been kind to holders lately. Which is why market structure is so important. As soon as you're getting a high time frame break in structure, your thought should be, okay, how do I preserve as much of this capital as possible? Is it staying in this meme and hoping that we're like, hope is never a good thing in trading. You know, you have your risk defined, and once your thesis is invalidated, just exit the trade, ideally in a higher low. Sorry, ideally in a lower high, so that you can preserve as much capital as possible. And if things regain structure and look bullish again, then you can look to re-enter. You know, there's this sort of hang up that we have psychologically that as soon as we sell something, if it starts to go the other direction, we think we've missed the opportunity. But there's always ways to get back on board of a trade, you know. And so you might miss out on a couple percents. I mean, on chain, it can be, you know, a significant amount of percent, but it doesn't mean that there isn't a trade to be had there. And in terms of like, so you also said my pump fund port is pretty terrible and super time consuming. It is time consuming. You have to be incredibly locked into the trenches, having uh, access to high quality group chats where guys are just locked in all day and this is all that they're doing, and you're sort of collectively researching and doing discovery and finding out details or connected to certain individuals that have inside information is a massive leg up. As well as having tools like ChainEDGE at your disposal is a massive leg up. Solana is a bit harder because at the moment on ChainEDGE, we don't track pump fund until those tokens hit radium, and the majority of discovery on Solana right now is on pump fund. So by the time that we're seeing them, a lot of the times it's late to the trade, which is why for ChainEDGE, the best way to use for Solana is by using the portfolio summary. And in particular, using the strategy that On-Chain Wizard has talked about for months now, and that has been very successful for many people, is doing the sub 10-day tokens. I actually prefer to bring it even lower to sub 5-day. I might even just put the filter on under 48 hours and look for tokens that start to creep up in balance held is a pretty good signal, especially when it aligns with the attention dashboard. You have, you know, your probability of those going on to give you X's, whether that be a 2x, a 5x, who knows, but the probability goes way up if you have those things in alignment. But otherwise, yeah, gambling on pump fund is incredibly time consuming and exhausting. especially when it's a narrative, a news trade, a narrative like we had yesterday with the Elon Musk and Trump interview. I mean, what a shit show that was. I mean, it was not enjoyable from a trenches perspective. Yeah. And if that's the way that things are headed, especially with the election coming up, I mean, we've seen whiffs of it here and there. But yesterday was sort of like the worst it's been, I think. And it's a sentiment that's shared across a lot of people that I know. It's just, it wasn't a fun experience. And the opportunity was limited. There was opportunity. And if you were with a group of guys that were incredibly locked in, like there were those several opportunities that popped up. I mean, even on the funny thing is on ETH, the way that I have my alpha stream filtered on the alpha stream for ChainEDGE on the ETH side, I only had one token pop up during the interview that hit my threshold for P&L and buy amount. What was the name of the token? Is it on here? No, not on here because it ended up dying off. Oh, yeah. It was the token, yeah. It was the only one that popped up during the interview, and it hit my thresholds, and I have pretty high thresholds for ETH. I think my P&L threshold is 400K, and my buy minimum is half an ETH. And there was only one token that popped up, and that token ended up having a decent run out of it. So, I mean, it's just a matter of fine-tuning your discovery tools if you're going to be on the gambling end of it. Okay. Would you say you've given a high conviction position size to the 0 to 5 day with 100K plus in holders? Yeah. I mean, if it's a sub 1 day token, depending on how much activity was, like say the token is just launched that day and it already has, pushing on 300K in holdings, that seems like a pretty high convicted position that these wallets are taking, and then you can size up accordingly. So where you might otherwise put in 0.1 to half an ETH, then you can say to yourself, okay, well, maybe I don't mind risking an ETH or 2 ETH or whatever it may be, whatever your bankroll amount is that you feel comfortable with putting into these things. Like say you're seeing wallets put in like 5 ETH clips or 10 ETH clips, and they're repeatedly putting money into the thing, and they're holding their money there, and they're not just selling for a quick 30 or 40% move, then the conviction goes up. And yes, anything over 100K, that conviction starts to get there, especially when you think, okay, say the token has, say the token's only at 1 mil market cap or 5 mil market cap. Well, if they have 100K of a 1 mil market cap token, that means that they're holding 10% of the supply, right? So these are factors that you need to take into consideration that, okay, these are quality wallets holding this percent of supply, means that, and they have good P&L, so they're not broke. The odds of them holding this to see it go higher is better than if you're looking at a token and it's only got like $5,000 of holdings, means that their conviction is pretty low in it. And then you follow that up with, it's been counterintuitive since sizing into the 0 to 5 day has performed safer than the high market cap older coins. This is just a victim of circumstance because the market has evolved into such an attention market that that's all that we're trading these days. And if the token loses attention, especially when liquidity is low, like we can see the volumes, like the volumes are certainly lower than they were in June, and definitely lower than they were through end of Q1, end of Q1 into Q2. Like there's a saying, it's called "sell a man, walk away." Now it's more of a tradfi saying, but when summer months come around, the liquidity dries up. So there's less liquidity sloshing around. So the older coins aren't going to have as much attention, given that who's left here in the markets is ultra degen gamblers. And I say that lovingly, like I'm one of them. So no, not a criticism whatsoever. It's just the older coins, because there's multiple factors here, and that's like a whole other thing on its own. But attention dilution, liquidity dilution, um, saturation, oversaturation of the available coins to trade. The ability to launch tokens so easily has meant that any little moment has 5, 10, 50, 100 coins launched, that it's difficult to get people coordinated around one coin, which is why the 0 to 5 day has performed safer. Now that may change at some point in time. And when it does, you just have to adapt your strategy towards whatever's working. Because even, what was it, like less than a month ago, some older coins started doing really well. And all of a sudden we had a meta in the culture coin and the culture and phrase meta that actually went for several weeks long and held pretty well. Now that has reversed, and a lot of those coins have come down quite a bit. But that was a changed market condition compared to what had been for probably about a month before that, where it was very much just new launches, new launches, new launches. And then that evolved. But now we're back to that sort of new launches, new launches, new launches. Now, are we starting to see the signs that might reverse if people are starting to accumulate some of these tokens that have broken structure as early signs that we might go on a rally for older coins that go on to be able, where you're able to hold them for longer? Possibly. We'll have to see. We don't know yet. Like, they're either buying a lower low and they're just going to be buying into a lower high, or there's going to be enough volume coming in and enough buyers coming in to shift structure back towards bullish, and they're going to be the change they want to see in the world, and they're going to create a higher high out of this. We'll have to see. But as of right now, yeah, the 0 to 5 day has been a printer. It's been a little bit less so for the last week, I'd say. Like, less and less has been popping up onto the threshold of 100K in balance on their portfolio. I've always sort of looked at on Solana, though, I think the threshold, especially for 1 or 2 day tokens, can be lower, around like 20, 25K, 30K or so, like that. But as it stands right now, there's not too much hitting that threshold. But I would agree, yes, new at the moment is safer. And it goes back to the point that I was talking about earlier, which was just you're either early or your exit liquidity. And until that changes, just approach the market with that sort of mindset. Okay. Let's see. Assuming something already meets a few ChainEDGE standard criteria, such as high P&L smart wallets holding over X amount, common biggest green flags you love to see. Well, if these things are aligning, like the holders look good, their balance looks good, I want to look at the chart. Is the chart bullish? What's the volume like? Like that's another part of my discovery too, is like, what's the daily volume? Is it hitting a certain threshold? And if the volume looks good and it's hitting this criteria and the chart looks bullish, well, then that's a pretty good alignment of conditions. Common biggest red flags to avoid. It's pretty much the same, but in the inverse. If volumes are low, then I maybe am not so interested in that coin. Or if the chart looks like shit, well, I'll probably pass until it starts showing signs of looking bullish. You know, we've had coins pop up on the attention dash that have, you know, been down only. And that's to be expected because the way that the attention dashboard is sort of calculated is a mixture of mentions off of Twitter from smart follows, mentions in Telegram channels, as well as the daily volumes of the coin, and a few other metrics. All of those things can be present for a downward trending token. So, you know, when all these ingredients align, you have to take every piece into consideration. You mentioned that you're mostly in, no, so you said, I mentioned that I'm mostly in capital preservation mode right now. That's not necessarily true. I'm in aggressive capital growth, but preserving those daily gains is a priority because of what the conditions are like. So I'll put my capital to work and risk the capital, but I like to lock in the gains until we get signs that, you know, you can buy a token and hold it for a week or two or a month. I mean, as I've said multiple times and repeatedly, I'm probably not the guy that's going to hold for a month. The irony is, though, like I've held ETH from my first buys in 2020 all the way up to the top in 2021, and then through all the drama and bullshit of 2022, and to the pico bottom of the FTX drama, and then all the way back up. So it's not that I'm not a holder. It just depends on what it is that I'm holding. And I saw, you know, after last cycle, I round tripped so many things or sold at a loss that I would much rather fold my gains back into the tokens that I know aren't going to just die off on me on a frequent basis. And that's just me. That's how I like to approach things. You know, I'm also a little bit older and trading is my job, and I have a family to support. And so my risk management is aligned with that, where I am in life. But I'm confident in my skills in trading that I have targets of amount of money that I need to make in a month, and I just go about doing that. And so once I'm getting to those levels, why leave the risk on the table rather than compound? That's just the way I view it, though. And, you know, many of you might be in different stages of life. You might have minimal responsibilities and a decent job, and you've got, you know, say you're mid-20s, you've got a decent job, and this is just a fun thing that you do, well then, shit, your risk should be different than mine. It's just, you know, every person's situation is unique, and you have to approach it from whatever your level of risk tolerance is and whatever you're comfortable with taking on. And that's fine for each individual. So the second part of that question, what are some easy signals to know you should be in this mode and signals to allocate more? Well, it's pretty simple, really. If new launches are running up really rapidly and then dying off the same day, and maybe only one or two coins survives the day, then you know what type of market we're in. If we're in an environment where you buy a coin and 5 days later it's holding structure and still going up, well, then it's a different environment. Now you can find these coins in less favorable conditions, like some have been doing decently for the last few days. But you just had to, it just comes down to being in tune with the market and knowing what things are looking like. And that adjusts on a day-to-day basis. It's also gauging sentiment in group chats. You know, people like to get very euphoric at moments, and perhaps that's a time to consider selling some things, or that maybe you should adjust your risk so that you're not getting into a bull trap. Or there's moments of despair where, had you, taking cues from your psychological cues about, okay, everyone's euphoric up here, maybe I de-risk a little. And then when it gets to, oh, everyone's feeling despair, maybe you can put some of that capital back to use. But you really do have to be in tune with the market. Like, this is a market that moves really fast, and sentiment changes on a dime, and people can go through it's so over to we're so back multiple times in a day. So you do have to be really in tune with the market and what's going on. It's a full-time job. Like, before I was doing this full-time, I would get so just frustrated from missed opportunities because I wasn't doing it full-time. So being able to be on chain pretty much 24/7 is a huge benefit, because you get in tune with the idiosyncrasies of how the market responds, and you're on top of the trends, you're on top of the meta. You you learn what certain things you want to be looking out for, and what things are positive, what things are negative. Like, it's like riding a bike on one hand, because once you get the gist of things, you never really lose those skills, especially if you're learning a repeatable skill, such as how to read a chart. But it is a momentum curve where, if you lose that momentum and you're away for a while, it takes time to get up to speed and to get into a habit, or a routine of moving fast enough. So, being on chain, being terminally on chain and terminally online is a massive leg up in these markets. How are we doing here? Okay, well, we're at the 2 hour mark. We're down to about 5 people remaining. We've gotten through a bunch of questions. We haven't really taken too many requests. It's been a little bit of a slower episode of me just kind of talking a lot, and sort of thinking on the fly through some of these things. The thing about, like, some of these questions is it's unique to each person's situation. So, I could answer them from my perspective, or my risk tolerance and goals, etc. But it's really unique to each person. So you just kind of have to have a framework for how you approach things. I do think that having segregated mindsets for how you use your capital is very important. Okay, here was another one. Thank you, Power Naps, for the good questions. Appreciate it. What's your threshold for volume, percentage of market cap? I don't really look at it as a percentage of market cap. The way that I use volume is never really a TA perspective, like on a chart. The way that I use volume is just as a gauge of attention. And there's sort of different thresholds for different chains. Like on Solana, it's pretty common to see coins with several $1 million in volume in a matter of hours, even less sometimes. But oftentimes, those ridiculously high volume coins in like less than an hour, often those are just farms. So also a good way to potentially avoid some things is, oh, this coin's 20 minutes old and it already has like 10 million of volume. Well, maybe I may want to avoid that. But for over a 24-hour period for Solana, it's not uncommon for things to be 5 million volume or above. Like right now, I'm looking at the. Let me change screen for a second. Okay. So right now I'm looking at the portfolio summary for Solana. Tokens aged up to 5 days with 10K balance and P&L threshold of 200K. I sort of find that as a good threshold on Solana. I used to have it a little bit higher at 400K, but then a lot of the earlier stuff was going under the radar. But if we look, I mean, 4 mil, 11 mil, 2 mil, that like all in the millions for 24-hour volume. What's interesting on this unicorn, the UWU token, UWU, it's only got 380K at 24-hour volume. That's kind of interesting to me. A little bit on the lower end. And we've actually seen price come down a bit on this coin. So it was an airdrop token, but the whole timeline's super bullish on it. And the platform itself is really interesting. But yeah, my threshold for volume for Solana would typically be 3 mil or above. I mean, there's not too much here. There's that Kobe token that we were looking at earlier. This Ken one, I'm pretty sure is a farm. It was either bundled or something, but I wasn't too interested in it. Haven't looked at Punk A or Punk I, but the balance is rather low. Good volume though, 7 mil volume. So that could be something you'd look into. But do I look at it as a percentage of market cap? Not really. I'm using it as a gauge of attention. Especially on newer tokens, you want it to be at a minimum on Solana 1 mil 24-hour volume, but preferably, somewhere around 5 mil or above is good. On ETH, a little bit different. On ETH, because volumes are generally lower, especially lately. I mean, look at that, the 2 coins on here on my thresh. So I only have this one on up to 20. So let's put it up to 3 to 5, the same as it was on Solana. Tokens up to 5 days old. P&L 400K. I find 400K is a really good threshold for ETH because there's just more whales. And their wallet history has higher P&Ls. Their wallet history has higher P&Ls and they're still early to things. Whereas on Solana, if you start pumping the P&L up, I find that the wallets are later to things, which tells me that they're probably trading better in a different environment than we are having right now. But on ETH, I'd say 24-hour volume in the 1 to 3 mil range is a good place to be looking. And we can see, 5 mil, 4.5 mil, 5 mil. And those, I mean, Kabosu was a good trade the other day. It's sort of come down a bit. And they're starting to de-risk a bit. But, I mean, 300K balance for a 2-day-old token. It's pretty good. Having 5 mil of volume. I kind of think that it's come down a bit. I mean, we didn't really get to any chart requests today. So maybe what I'll do is maybe we'll just do a chart request show tomorrow to make up for it. And this will just fully be a Q&A session, as it's obviously been. And I know there's more questions about workflow and things like that, like how am I doing discovery? What I typically do is I'll have an alpha stream open for ETH or EVM. Base stuff pops up there too. So I'll have an alpha stream open for ETH. Right, have my filters up. And here I can change the screen if you guys want to see that. Where's the ETH one? I mean, it's pretty quiet right now. Relatively slow day on chain, especially for ETH. Volume's been pretty low. I mean, we're sitting at, what's Gwei looking at like right now? Yeah, about 1 Gwei. So volume's been pretty low. There's not much up here right now. But what I'll do is I'll have an alpha stream panel open for ETH or EVM and an alpha stream panel open for Solana, both visible at all times. And this is usually what I have my filter set to. Transactions within the last 2 hours. If it's busier, I'll switch it down to 1 hour, just so that I'm really locked in on what's happening quite rapidly. But 2 hours, tokens up to 48 hours. I'll even extend that to 3 to 5, 6 to 10, depending on conditions. But given that tokens really haven't been lasting much longer than, a day or two, I really just want to be focusing on the new stuff. 400K P&L. I don't mess around with win rate or emojis. And then minimum buy amount. And what I do with this, I'm not specifically looking at a dollar value. What I'm doing is I'm aligning that with an ETH amount. And for the alpha stream, I like it to be a minimum buy of half an ETH. At some point, we're going to be integrating that you can set up filters by denominator amount. So half an ETH, 1 ETH, 5 SOL, 10 SOL. I think that'll be super useful so that we're not having to constantly update the filters. Excuse me. But yeah, this is how I have ETH set up at the moment. I find it's pretty good it's a good threshold for early. Like I don't put any wallet amounts. On alerts I will. But just for the alpha stream, I don't put any wallet amounts. And then, you're just sort of monitoring this combined with using alerts so that if your attention was elsewhere, but you get a ping or something, you can pop over quickly. I don't even once the alerts come in, I don't even have to open the alert. I can just look at the alpha stream and see what it is that I'm getting pinged for. So that's ETH. And can open up Solana. Now, Solana is there's nothing on my alpha stream at the moment. Tells you how quiet it is right now. I don't know why that's taking so long to load, but yeah. Also, same thing, 2 hours, although often on Solana, I will keep it on 1 hour because there's just so much happening. ChainEDGE filter, same. I have it set up same for ETH and Solana at the moment, just because that's what the conditions are. It's your early or exit liquidity. I have the threshold at 200K. If it's busier, I'll bump it up to 300K, but 200K feels like a good threshold for Solana for our wallets. And then minimum buy amount, again, based off of denominator amount, not a dollar amount. So this is roughly aligned with 10 SOL. Now you can put it at 5 SOL if you want to be earlier. Like I bet you if I, what is 5 SOL worth right now? SOL is trading at 144, so $700-ish, 700 and change. So you could drop that down to try and see what's happening in the 5 SOL range. But it honestly looks like nothing's happening right now. So really useful. Oh, there we go. There's a token called Gussie. Those transactions were over an hour ago though. So you can look into that if you want. But that's essentially what I'm doing is I have my alpha streams open. I have group chats open that I'm in frequently. Like I make very extensive use of Telegram. Portfolio summary, one for ETH, one for Solana. I showed those windows earlier that I've constantly scanning through to see what's popping up. And I really lately just have it filtered up to 48 hours. But you can have it 3 to 5 or 6 to 10. 6 to 10 was the sort of OG threshold that OCW first noticed this strategy working for. It was sort of narrow. I think he talks more about 3 to 5 now being the threshold. But if I'm really trying to just be locked in on new stuff, I'll just put it right down to up to 48 hours and just refresh it constantly and see what's happening. That combined with the alpha stream, because you're not going to get immediate portfolio balances. The quickest way to see those is off the token pages. So I'll just have the alpha stream rocking combined with the alerts. It's what it is having multiple ways of information being at your fingertips and being alerted to. Because, if you're locked in with your buddies in a good group chat, someone there is going to someone there is going to notice the coin and bring it to your attention. Or you might be the one bringing the token to their attention because you saw it pop up in the alpha stream or you got an alert. It's just about having multiple ways of that information getting to you as quickly as possible. Yeah. I think maybe we'll wrap it up. Unless anyone has any further questions. Again, I sort of apologize that we didn't get to too many of the requests. Maybe what I'll do is we'll do a faster request show for charts, just charts tomorrow. I think maybe that's what we'll do. Since this one's open, maybe I'll just do a quick analysis on this. Kobe had been one of the hotter Solana tokens of late. It's actually on the portfolio summary. It's got 76K of holdings, it says. From 4 wallets. 4.7 mil 24-hour vol. Pretty good. Looks as though while it's holding, it's pretty much at their entry price. So they're hoping it's going to bounce from here, but you can also suspect that if it starts losing a level, they might start to sell. So H4 fair value gap. Could also see it come down into here before it loses structure. Let's get our range rocking. Swing low. Swing high. We could even, toss a fib up to see what sort of alignment we're getting. So it's into the golden pocket right now. It's funny how the 786 aligns perfectly with this demand here. See, these are the things of confluence that I look for, right? Like, say you're still trying to find confidence in your analysis or confidence to pull the trigger on a trade. Well, you look for these sort of layers of confluence. Over time, you can stop, you don't have to rely on as many factors once you get a good feel for things, but all these things help and add up because guaranteed there's a lot of traders looking at fibs as well as a lot of traders looking at structure and demand. And so the meme, so TA is in itself a meme. Like, there's no real reason why something should happen at a certain spot other than the fact that people are looking to those levels for something to happen. And if enough people are looking to those levels for something to happen and react in those areas, then you're going to fulfill the meme prophecy, right? So that's really all it is, why the probability is there, because it's a psychological phenomenon. So that's what I'd look for. I would look for this to hold. It's holding now. The trouble is, like, what are you going to do? If it loses this, are you going to cut when there's demand right there? It's a bit of a tough one. So we'll see. This is one we can come back to tomorrow, and I'll take a look. Yeah, I think I'll do another stream tomorrow. We'll do a much faster paced charts specific, like charts only stream. I don't think there were any more questions. Let me just look on this other sheet that I have really quickly. Position sizing, we sort of got through that. Portfolio management, we sort of got through that. I mean, that's my personal portfolio management. I know some people that are allocated fully to memes. I know some people that have gone risk off for the summer. There's various approaches. It just has to adapt to what works for you. Show you ranges. I think we did the ranges, although, again, we'll go through that every stream. A focus on ChainEDGE and how to spot new launches would be awesome. So I think we'll do a more frequent series of just doing discovery using the tools. Less so in this Q&A. Like, I did a little bit of that. I just ran through that towards the end there. But in the future, we can look to just sort of have discovery sessions. Why not? Port size, we dealt with that. Portfolio percentages between different coins. I mean, as I said, I'm pretty much max allocated to my denominators, and then I'll rotate in and out of memes. Yeah, I think we got through all of them. This was actually interesting. Some insight on keeping track of multiple positions. Is it very systematic for you to find stop and take profits, or discretionary? I try not to have more than 1 to 2, maybe 3 higher conviction plays on the go throughout a day. And then with my more gambling stack, really just, I try to just be one at a time, because you have to be so locked in, because they move so quickly and could turn against you so rapidly that you have to just be focused on that chart. At least for me. I know guys that can juggle being in 5 different gambles or more at one time. It doesn't work for me. And that's more gambling than I need to be doing. And in terms of the defined stop loss and take profits, I mean, if you use something like BullX, it has a really great complex strategy built in to the platform where you can just define multiple take profit targets percentage wise or market cap wise and how much you want to sell in those. And it's one click and it'll deploy that strategy, which is something that's very useful. And if you're interested in testing out BullX, you can, I'd appreciate if you use the ref link in the description, or there's a link in the Telegram and the links channel. Not an official affiliation whatsoever, but having the ref link does provide some kickback. So if any of you are looking for a new terminal to check out, that's one of the main highlights of that tool, actually, is the sort of layered TP and stop loss strategies that you can use. It's literally you just define it beforehand, and you can turn it on so that as soon as you enter a position, it'll automatically set that up on the trade, which is really quite nice. In terms of TPs, like there's various ways that you can do that. Something that is not a bad strategy, especially for the brand new stuff, is you throw your fib up. And I shared, for anyone interested, I shared my fib settings in the Telegram, but I can also do that again. I can put it in the resource channel so that people can find it a little bit easier. And I'll share those in there so that anyone that's interested can set their fibs up in the same way, so that when you're following along on your charts, it's easy for you to see and align with what I'm doing. They're not the end all be all of fib settings. You can have a myriad of fib settings and suit them to your needs and tastes. The way that I have them set up, I've got some custom levels in there, as well as your standard pocket 786. But what you can do on a fib tool is you can have not only retracements, but extensions, and on the same, let's get rid of this volume, on the same fib. So when I draw a fib, now this is, we're not on the 1 minute here, so it's not or like 5 minute. This is a 4 hour, so I have no idea if it's going to get up here. But say you're on a 5 minute chart. Say this was a 5 minute chart and it's rapidly moving, and you've placed your fibs, got your entry. Well, you can look to extensions to think about where you might want to TP. Your first target would be top of the range. Second target would be a few of the extension levels. Second, third, some of the extension levels. And that's one strategy of setting your TPs. Another could just be, okay, at a 2x, I want to take my initials. That's one strategy. Or at a 2x, I just want to be fully out of the trade. Like, it depends on how aggressive you want to be with taking profits, whether you're in more of a preservation mode or the market's giving you opportunity to go higher. But at a bare minimum, you want to see it get back to the range high. If it's not even getting to the range high, then the token's weak, and you move on. And in terms of stop loss, stops are difficult on chain because so often you can see that we just get a wick through the level, but it maintains structure. But you can define your, especially if you're trading on really low time frame, you can define your stop below a demand area. And if you're able to get in towards the bottom of demand, which is where your structure, where your trade would be invalidated, if you can get in as close to that as possible, you put your stop, maybe on chain, I would say like 30% below is probably a good area to account for some sort of wick through that area. But if you're able to get in close to the bottom of the range, you put it 30% below, and you're only risking, let's say 3% of your portfolio, and you lose 30% on that. Well, then, you live to fight another day. Oh, looks like we've got a few more people that joined us. Oh, and then they disappeared. Okay, well, we've been 2.5 hours. Okay, here's one. And again, thanks for all the questions, Power Naps. I do appreciate your engagement, your interaction, and keeping the conversation flowing. Too scared to leave much size in TG bot wallet. This is where it's important that you define your strategies and split them into separate wallets. Now, I use multiple trading terminals. I don't really use TG bots because I don't really like the TG bot trading experience. I like a full featured terminal. And as you're saying, you use BullX just for pump fund port. If you're taking a higher, yeah, I guess because you're talking about placing stops and whatnot for a larger. Well, if you're trading off high time frame, so here's the second part of this question. Jupiter limit orders because of the hassle, just for the safety. I mean, if you're trading higher time frame and the token's been around for a while and you're not really concerned about rug risk, then you can monitor on more of a manual stop. But what I would do is I would set up alerts on Deck Screener or whatever platform you're using to chart on, provided they have alerts. But you could set up alerts on Deck Screener and set the alert maybe, I don't know, 20% above your invalidation level, so that as it's approaching, you get the alert, and then you can open up the chart and decide what you want to do in real time, right? Like, hopefully, what this is part of the thing about how much risk and stress you want to take on, and at what stage of life you are. Because when I go to bed, I don't really want to be woken up in the middle of the night to alerts. Yeah, so you know, you set up your alerts, and oh, I don't know if I just cut out there or something. Looks like I lost internet for a second. Hopefully, I'm still working. Am I still working? Can you guys hear me? Yeah, I mean, limit orders on places like Jupiter, not the best. Like, you can use like the DCA out function and stuff like that isn't bad. But in terms of like straight trading, it's not, it's not going to be as good as something like BullX, or Photon even has limit orders and TPs and whatnot. I think the risk of, yeah, I get it, like wallet risk, and you want to spread around your capital so that you're not susceptible to a hack and stuff like that. It's a fine line. And once your port grows to a certain size for your, like a wallet that's integrated into BullX, you should be pulling out of there. On a regular basis, so that you're not leaving in more than you're concerned about losing. And these like we've seen, like Thunder had an exploit, Unibot had an exploit. I mean, these things happen. It seems, the longer these platforms survive, though, that concern is a little bit alleviated. And fortunately, these platforms have done the right thing in repaying customers. I mean, you have to remember, like, these platforms are cash cows. Some of the most profitable tools or platforms or dApps or whatever the fuck we want to call them, some of the most profitable companies in crypto are trading bots and terminals. Why? Because they're taking a 1% fee on each trade, an open and a close, a buy and a sell. They're taking their 1% fee with people putting in millions and millions of dollars of volume per day. Like, I'm not saying on an individual level, but the platforms, and I mean, some people might be, but the platforms are seeing that level of volume. So it's a massive cash cow for them. So it's in their best interest if something like a hack or an exploit occurs that disrupts user funds or user wallets, that they repay. So yes, there is a level of risk. I'm not overly concerned about it. You just don't leave more than, like, you just spread it around a bit. And what's also good too is that most of these platforms allow you to export your private key, and you can, in the event of something occurring, like the website going down or something, you have access to your funds. I know Bullx, you can't do that. It's a built-in wallet. I know they also, like, to take funds out of Bullx, you have to like approve your wallet. So I'm sure there's some sort of security reason behind that, so that in the event of some sort of exploit, funds can only be removed to the wallet that's on there and not to someone trying to update the wallet last minute and just pull all the funds out. I'm sure there's some reasoning behind that. I didn't look into it, to be honest. Or I didn't look into it too deeply. It was a question early on, but it was sufficiently answered. So yeah, I mean, it's the sort of play at your own risk environment, but and every element of it is risky, right? Like the coins are risky, leaving funds is risky. I think it's a lot less risk than what ended up happening with like an FTX, because you do still have control of our crypto. So yeah, I wouldn't be leaving $1 million in there, or a couple $100,000 in there. Although I know people that do. Like Maestro, the OG TG bot, people would have massive amounts in there. And they ended up getting exploited, and then they refunded people. So, the companies tend to not want to mess up a good thing. Okay, well, gentlemen and any ladies that ended up listening, although I have a feeling it's a bit of a sausage fest. I do appreciate you all tuning in. Again, my name is 0xRapture, although I don't even think I said my name at the beginning. I think we just dove right in. My name is 0xRapture. The show is Astrology for Men. This was a more Q&A session, class in session vibes. The next stream will be back to the chart requests. It'll be a faster paced show, brought to you by the Daily Edge. Here, let's throw these up. thedailyedge.com/subscribe, your daily newsletter sent straight to your inbox of actionable intel on the on-chain markets in terms of flows and attention, written by On-Chain Wizard. You get his years of insight and intuition and baked into those newsletters. There's always alpha in the newsletters. And even if you're not a ChainEDGE subscriber, just subscribing to our free newsletter, again, it is free, will give you some very useful information about the previous 24 hours. And it highlights portfolio holdings. It highlights attention dashboard. It's a really great newsletter that, I have access to all of the ChainEDGE data and access to onchain wizard, but I read the newsletter every damn day. We're also in partnership with ChainEDGE, obviously pretty apparent. So I want to say thank you to ChainEDGE and ChainEDGE. Don't forget to like, subscribe, and comment if you're enjoying these shows. This one was a little bit bumbly, I have to say. Don't think it was as smooth as the last one, but this is more of me just thinking out loud about these questions and like my perspective on things. So sometimes I have to think about it as I'm saying it and figure out how I feel about these things and what my views are and how to give quality responses that are useful to different risk tolerances, different portfolio balances or portfolio size. You have to sort of think through the different angles on these things as you're responding to them. So hopefully I did a decent enough job. Also, don't forget, links are in the description below where you can find links to the Daily Edge, the Daily Edge Twitter, the ChainEDGE Twitter, my Twitter, onchain wizard Twitter, our Telegram group, as well as the 0xRapture link. Don't forget to subscribe to our YouTube, where these videos will be coming out. I'm so far 2 to 3 a week, I think, and I started this a week ago and this is already the 3rd video. So I think we're doing pretty good. I think I'm going to do one tomorrow for the chart requests. We'll see how I feel in the morning. A lot talking for almost 3 hours straight here. We'll see how I'm feeling tomorrow, but I think it would benefit people to get some chart updates. I know we didn't really get through many at all today, so we'll do that tomorrow. And I will leave you with this one quote that I really like from Goggins. Don't get ready, be ready. And that's what learning all this stuff really is. It's so that in the moment, rather than trying to get ready, you're just ready to take action. Because if you have to prepare yourself to get into a trade, then the trade is already going to pass you by, especially if you're playing super early and attention focused and new launch focused. If you're like, okay, I got to move funds into the wallet and now I got to do this and I got to do that. Well, you're just giving yourself opportunity to fail on that trade or to miss the opportunity altogether. So it's all about being ready and not having to get ready. And I thought that was good. Okay, everyone. Well, I appreciate you joining. It's been a nice chat. I appreciate the nice comments and appreciate the few of you that stuck through the whole. Hopefully it wasn't too painful listening to me speak for that long. And check out, keep an eye out in the Telegram tomorrow, because I most likely will do a stream tomorrow and I'll announce it in there and we'll just run through the chart requests pretty quickly. Maybe we'll try and keep it to an hour tomorrow, just as a quick run through of all the requests. Again, I am 0xRapture, and I want to thank you all for joining. Have a great rest of your evening, and talk to you soon. Let's put some of that music back on so we can vibe out on the way out.